Most traders end up losing money whenever they buy an option ahead of an earnings report. Today, I'm going to explain why that happens, helping you understand IV crush, and finally, at the end of this video, I'm going to give you 4 strategies to help you make a profit off of earnings. Hopefully you learned something from this video, and hopefully you can make some profits this earnings season. If you do, show some love, leave a like, and let's get into it. So what is implied volatility? Well, just as the name suggests, this is the expected future volatility for a given stock. And the way that this is calculated is through the options chain, depending on how many people are buying options. This is based on supply and demand within the option chain, since whenever people are buying options, they're expecting a big move for the stock. So simply put, the more people that are buying options, the higher the implied volatility. And typically, implied volatility is highest around earnings reports or some other sort of big event like a product reveal. More people are usually buying options ahead of these big events. That way, whenever the stock makes a big move after the big event, then hopefully they can make a profit. But what happens after the big event? Well, expectations for the stock drop because it makes its big move, and now people aren't expecting the same amount of volatility. They end up selling out of their options, and implied volatility actually drops after these big events. But how does this affect your options? Well, just like we talked about earlier, whenever there is a earnings report or another big event, more people are buying options expecting a big move from the stock, and whenever there's more demand than there is supply with anything, prices tend to go up. So this means that you're going to pay even more in premium in order to buy an option ahead of an earnings report, which means that the stock needs to move that much more in order for you to make a profit. If the actual move from the stock ends up greater than the expected move based on implied volatility within the options, and you guess the direction right, then you can make a profit. But of course, if you guess the direction wrong, this works the same way that it usually would, you would still lose money. So again, you have to guess direction correctly, and you have to guess volatility correctly. And this is why most people end up losing money buying an option ahead of an earnings report. The volatility from the upcoming event is already priced into your option. Again, you're paying more in premium to buy an option ahead of these earnings reports. And if the actual move is less than the implied move from implied volatility, then you would still be at a loss, even if you guess the direction correctly, because implied volatility is going to drop, which is going to drag down the premium for that option. The way this works is whenever implied volatility drops, for every 1% that it drops, your options will lose its Vega value. Now, Vega is one of the fancy Greeks, and if you don't understand them, I have a video for that. But again, for every 1% drop in implied volatility, your options will lose its Vega value. So if you have, say, a 0.1 Vega value, and the option's implied volatility drops by 15%, then that option is going to lose $150. This is not considering any price action and also not accounting for any theta decay. But how can we avoid this IV crush? Well, the obvious choice would be not to buy options unless you expect the stock to actually move more than the expected move in the options chain. And a good way that you could gauge this is through Thinkorswim, the app back here. And on the options chain, you'll see the expected move for the stock on the right. If the stock ends up moving more than this expected move, then if you guess the direction right, then you'll be at a profit. But if it moves less than this expected move, and you guess the direction right, you can still lose money. And of course, if you guess the direction completely wrong, then you'll lose money as well. A good example for this right now would be Tesla. Right now, they're trading at around $985, and their next earnings report is scheduled for $420 after hours. So if we go to the option chain under the trade tab, and go to the next expiration after 420, that's going to be 422. And on the far right, you can see that the expected move from implied volatility is going to be $75. So this means that Tesla is expected to be somewhere in the range of $910 and $1,060 after their earnings report. So if you're to buy an option right now and you're expecting Tesla to go up, obviously you'd be buying a call option. So if you were to buy one of these call options, you would want Tesla to be above $1,065 in order for you to make a profit based on implied volatility. But if you think that Tesla is going to have a negative earnings report, then you'd be buying a put option on the right, and you would need Tesla to be below $910 in order for you to make a profit based on implied volatility. But if Tesla is somewhere in the middle of that range between $910 and $1,060 after the earnings report, then both people that bought the call options and people that bought the put options would both be crushed. So the gist of this is that the actual volatility has to be greater than the implied volatility, and you have to guess the direction correctly in order for you to make a profit whenever you're buying an option ahead of an earnings report. Another way that you could take advantage of this would be to buy the option well before the earnings report and then sell it right before the earnings report. That way you capitalize on the implied volatility rising ahead of the earnings report. Right now we're about 2 weeks out, and if you sold this say 1 to 2 days before the earnings report, implied volatility would likely be higher than it is right now, and if you guess the direction correctly, then you would make even more profits. And probably the best way to make money off an earnings report is to sell options instead of buying them, because typically actual volatility is going to be less than implied volatility, which means when implied volatility drops after the earnings report, you're usually going to make money if you're on the selling end of an option. So if I think that Tesla will actually stay within our range of $910 and $1,060 after the earnings report, I'd be selling options instead. So if I think that Tesla is going to go up, or at least stay above $910, our expected range, I could sell this 910 put for $975. Now, if Tesla continues to tank past $910, then I'll have to buy 100 shares, but I would only be at a loss if Tesla was below my break-even price, which would be $910 minus my $975 of credit, for a break-even of $902.50. And then if I thought Tesla would go down, or at least stay below the lower range of $1,060, we'd go about selling a call option. So this call option right here is going for $1,145, which means if Tesla is below $1,060 after this earnings report, then I would get to keep that $1,145 of credit. I get to keep the 100 shares that I own of Tesla. But if Tesla is above our $1,060 price target, then we would end up taking a loss if it's above our break-even price, which would be $1,060 plus our $1,145 in credit for a break-even of $1,071.45. And another way to mitigate IV crush is by using spreads. And the way that this works is you're buying an option and you're selling an option. So whenever you buy an option, you're going to have a positive Vega value since you're long the option, but then whenever you sell the option against the long option in your spread, you're going to have a negative Vega value. So these two Vega values are going to end up balancing out to some degree and end up with a much lower Vega value than if you were to just buy or sell an option. And this is probably the safest way to go about trading ahead of an earnings report. For example, again, if I think Tesla will stay above my $910 strike price, I could buy a call debit spread. So what I would do here is buy the 905 call and then sell the 910 call. And if we look at the Vega values on the left, this one has a 36 Vega, so we'd be buying that option, so we would have a positive 36 Vega. But then we would sell the 910 call against it, which has a 39 Vega value, so we would have a negative 39 Vega value for a net negative 3 Vega value. This means whenever implied volatility drops after the earnings report, then this call debit spread will actually gain value. For every 1% that implied volatility drops, this call debit spread will actually gain $3. But we still have to get the direction right. Tesla still has to stay above $910 in order for us to take maximum profit between these options. If Tesla goes below my 905 strike price, then of course we would take our maximum loss, just like we would in a regular debit spread. So those are the 3 ways that you can fight against IV crush. Hopefully this video helped you out. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one.